Almost everyone believes the same thing about money, and almost everyone is wrong. Ask where money comes from, and most people will say the government prints it. Picture the printing press. Sheets of fresh notes rolling off the machine, stacked, and shipped to banks. That does happen. Physical cash is printed, but cash is a tiny fraction of the money in the world. In most modern economies, notes and coins make up around 3% of all money. The other 97% has never existed as paper. It exists only as numbers on a screen. So where do those numbers come from? Story we're all taught goes like this. Savers put money in the bank. The bank keeps a little and lends the rest to borrowers. Money moves from one pocket to another. The bank is a middleman. Nothing new is created. That story is wrong. The Bank of England published a paper in 2014 saying so directly. Here's what actually happens when you take out a loan. You walk into a bank and ask to borrow $10,000 for a car. The bank checks whether you can repay it. If it says yes, it does two things at once. It writes $10,000 into your account as a deposit, and it writes $10,000 into its own ledger as a loan you owe. Watch carefully. It did not move that money from a saver's account. It did not take it from a vault. It typed it. The deposit in your account is new money that did not exist a second ago. Your debt and your money were created in the same instant, as two sides of the same entry. This is the part that breaks people's brains. The loan does not come from deposits. The loan creates the deposit. You now go and buy the car. The money moves to the dealer's account, possibly at another bank. But it does not disappear. It is still in the system, being spent, still counted as money. The moment you were approved, the total amount of money in the country went up by 10,000. Now run it backwards. When you make a repayment, the opposite happens. The bank cancels part of the loan and cancels part of the deposit at the same time. That money is not moved somewhere else. It is destroyed. It stops existing. So money is created when people borrow and destroyed when people repay. The money supply is not a fixed pile that gets passed around. It breathes. Which raises the obvious question. If banks can type money into existence, why don't they type themselves infinite money? Because there are real limits, and they bite hard. The first limit is finding someone who wants to borrow and who can actually pay it back. A loan is only an asset if it gets repaid. Lend to people who default, and you have created money and destroyed your own capital. The second limit is competition. Every loan you create can be spent at another bank. When your customer pays someone at a rival bank, you must settle with that bank using central bank reserves. Reserves are a different kind of money. They are the money banks use with each other, and only the central bank makes them. So a bank that lends recklessly finds money draining out of its doors and has to borrow reserves to cover it. The third limit is regulation. Banks are required to hold capital against their loans and to keep enough liquid assets to survive a bad week. And the fourth limit sits above all of it. The central bank sets the interest rate. Raise the rate, and borrowing gets expensive, fewer loans are taken out, and less new money is created. Cut the rate, and borrowing gets cheap, more loans are taken out, and more money enters the world. That is what interest rate decisions actually are. Not a lever on some pile of existing money. They are a tap on the rate at which new money is being brought into existence. Now what about the money the central bank makes itself? You've heard the phrase quantitative easing. That is genuinely new money, created by the central bank. But it is not handed to the public. The central bank creates reserves and uses them to buy assets, mostly government bonds, from financial institutions. The seller ends up with money instead of a bond. The hope is that this pushes down interest rates and pushes investors toward riskier, more useful lending. Whether it works as intended is argued about to this day. Step back and look at what all of this means. Money is not a substance. It is not gold in a vault, and it has not been for a very long time. Money is a record of debt, a number that exists because two parties agreed on a promise. The notes in your wallet are an IOU from the central bank. The balance in your account is an IOU from your bank. That sounds fragile, and in one sense it is. The whole thing runs on the belief that those promises will be honored, which is why a bank run is so dangerous. If everyone asks for their promise to be turned into cash on the same morning, no bank on earth can do it. But it is not a trick, and it is not a scam. It is what lets an economy build things before the money to pay for them exists. A factory, a railway, a house, borrowed into existence, and paid for by the value it creates afterwards. Money is not printed into your life. It is promised into it. And every single one of those promises started as somebody, somewhere, agreeing to owe.